Let's welcome in Jeffrey Currie. He is Goldman Sachs' Global Head of Commodities Research, live with us today from London. You've been a busy man, Jeffrey. I don't envy you trying to figure out where the price is going to go. And you have this note that was the talk. You say, quote, the prognosis for the oil market is more dire than in November of 2014 when a price war last started, as it comes to a head with the significant collapse in oil due to demand due to the coronavirus. It sounds like you're describing a perfect storm to drive prices lower. The question to you is how low?
Well, I like to think about this price war as being really more of a second round effect of the virus. And the reason I say that is the collapse in demand and the collapse in prices created the leverage for Russia to really start this price war. And I don't really like to call it a price war. I like to call it a market share strategy. And we like to emphasize that the economics or rationale of a production cut never made sense to begin with. I like to point out, going back to 2017, OPEC plus producers cut 4.4 million barrels per day. What did this do? It led to a 5.7 million barrel per day rise in non-OPEC production. So 4.4 down, 5.7 up. And more importantly, the economics behind that 5.7 million barrel per day rise were miserable, and it was all taken out of equity shareholders.
What's a reasonable price? If the market overdid it over the weekend into yesterday, what's reasonable to you in say, the next 6 months?
Our base case is really one of $30 a barrel. And this is predicated on these higher levels of production being extended through the end of the summer months and then demand finally catching up and the market shifting into a deficit by the end of third quarter and early fourth quarter. There's a lot of noise around a potential agreement, particularly with the announcement out of Alexander Novak that they're willing to come to the table in May or June. But it's important to emphasize two things. One, an agreement is not necessarily bullish. It could be an agreement to extend the market share strategy. In terms of thinking about the second point is that if they meet in, let's say, June, the earliest you're talking about an impact to supply is probably sometime in July or August. So our assumption of, the next 6 months are likely to be painful, I think is pretty reasonable.
Not sure if you had a chance to listen to Mark Fisher, the famed oil trader on our program yesterday, who suggested this could go on for a couple of months. Oil could be back in the 40s. He said it's an overreaction from Russia and Saudi Arabia, what they've done. Is there truth to that?
No, because if you look at this should have happened back in 2015 and 16. Why did it not happen? Is because China hit the stimulus button, OPEC cut production, and then you had U.S. fiscal policy after that. That kept prices artificially supported at around $60 a barrel, and you never saw the rebalancing that needed to take place. And so with the prices down at these lower levels, we're seeing an acceleration in that rebalancing process that is going to create a healthier industry as we look out 2 or 3 years from now. In fact, we do the calculations that show that Saudi Arabia will be better off by extending this this year by early to or mid 2021 at prices somewhere around $55 a barrel because they'll have much greater market share. So again, I think this is a rebalancing that needed to occur but was simply delayed due to OPEC production cuts and stimulus. Again, the cuts just don't make sense.
So, Jeff, with that healthier oil market, does that lead to ultimately a place of massive consolidation?
Yeah, I think you're going to start to see some real problems beginning to develop. I think the stress on the balance sheets were already there before Monday. You asked the question, why now? And I think the why now, one of the big ones really was the balance sheets of these companies were already substantially weakened. Then the pullback yesterday, as you're already seeing, there's substantial problems with many of these different smaller E&Ps. They're laying down rigs. They're having a substantial impact on forward supply. Now, what's going to happen to these assets, I think, is critical. If you were a complete Russian strategist here, what would you want to do? You would want to create zombie companies out of these U.S. E&Ps. By zombie, meaning that they don't go bankrupt. The current managements and balance sheets continue to control those assets. Because if you get complete restructuring, which we expect will happen, the assets go back out into the market because you can't get rid of the assets. You'd have to blow them up, and that's not going to happen. As a result, the assets change hands, go into a healthier balance sheet, and you end up operating them in a more efficient manner in the future. That's what needs to happen. That's what should have happened in, let's say, 16 and 17, but we didn't get to that because we had the higher prices being artificially supported.
So you're making
absolutely consolidation.
I'm sorry, finish your thought. I apologize.
No, it's just I'm saying your point about consolidation and rationalization, it's something that needs to happen in this industry. But here's a stat. If you look at ExxonMobil relative to the S&P 500, that ratio is raced 50 years of gains. I mean, these stock prices are sitting on real low levels, which telling you, hey, this restructuring needs to happen.
Speaking of companies that pay big dividends like Exxon does, I'm sure you saw the news that Oxy just cut its right before our show came on the air, which our David Faber was talking about. I assume you don't think that's going to be the last that we're going to see.
No, not at all. I bet the question is, will the big majors, the super majors, like Exxon, Chevron, BP, Shell, will they be forced to cut their dividend? Unlikely. They got very healthy balance sheets. They're the ones positioned to ride this out. But also, when we think about the consolidation process, they're the ones going to have to drive this. They're the ones that are going to have to create the efficiency. The question is what's going to happen to these smaller E&Ps and much more of that high yield sector. There's a lot of question marks around that sector.
How many companies in that sector do you think can go out of business?
I'm not going to speculate on. There's a lot of them here. If you look at, here's a stat.
Dozen? More than a dozen?
5 companies. Well, way more than it does. You think about, they get consolidated in some shape or form. If you go, when you look at 80% of U.S. production is produced by 50 companies, 20 is produced by the top 5. The top 5 meaning Exxon and Oxy is one of those top 5, and they're having problems right now. So let's say the top 4. That 80% of the production by those 50 companies is going to need to be consolidated. It should have been consolidated years ago. Ultimately, when we're in this environment, that's what's going to generate that rationalization. Bob
Diamond has a question for you, Jeff.
Jeff, you know the industry, and I'm not an expert by any means, but I add to what you're saying that since 2008, with zero interest rates or QE1, QE2, QE3, easy monetary policy, credit, the proliferation of credit is all over. And what we're seeing is the biggest impact of that growth has been on the triple Bs and the lower end, which is exactly what you're talking about. And our sense is that one of the consequences of what we're going through here is going to be a real crack in credit, where there's so much fewer covenants, so much greater issuance, so much more outstanding at the low end of corporate credit in the U.S., particularly in dollars. And that ties into what you're saying, doesn't it?
Oh, absolutely. And again, the problem with this industry and what's keeping the cost structure for that group, it supports the cost structure, was supporting the cost structure around $55 a barrel. If you take out that group, the cost structure of the U.S. shale sector drops to around $45 a barrel, and a lot of that's driven by the debt that you're referring to, that in many cases is just simply uneconomic. A lot of those companies are already officially zombies in the sense that you have the assets tied up, they can't make capex investments. Because before we went into this downdraft with the coronavirus, we were bullish longer-term oil and commodities based upon underinvestment. And one of the key reasons they were underinvesting, too much of the cash flow is being redirected to paying down debt as opposed to capex and drilling for future oil.
Well, bye-bye capex. I mean, that's going to be one of the ramifications of all of this because of...
Oh, yeah, absolutely.
Yeah, because of certainly what we've seen. But you laid out pretty explicitly earlier in a comment you made about why this is all happening and what the end game truly may be for what the Russians are trying to do. And that is to bring our shale companies, if not others, to their knees. So they're going to be willing to play this out as long as it takes to try and do that?
Yeah, I'm willing to argue they're willing to play this out through the summer months because you got to realize that for countries like Saudi Arabia, it's going to put a lot of pressure on them. I do want to point out when you look at Russia, it has the reserves to survive in this environment for 6 years. Saudi Arabia, while it is not financially healthy right now, it does have a lot of debt capacity, particularly relative to the debt levels it ran during the 90s before we went into the bull market of 2000. So if Saudi Arabia is willing to start to amass debt, it too can survive this for quite some time. But I do think that by the time you get to the summer months, the question, I mean, look at the impact it's had just in 36 hours. It's amazing how many rigs have been laid down in terms of, looking at capitulation of different companies. So, does this need to go on for beyond 6 months? I think there's a question mark. But I think that, the key point is that if you just look at, actually, another big news point today was that Saudi Arabia announced its production for April is likely to be 12.3 million barrels per day. That's an extra 2 million barrels per day of crude that have already been subscribed by refineries that's going to displace spot barrels. So you have the potential for a lot, significant downside spikes towards $20 a barrel in coming months.
Wow. Grateful for the time, as always, Jeff. Thanks so much.